The way we are able to purchase properties, or the reason we actually have so many opportunities still, even in this time where a lot of people are saying there aren't a lot of opportunities, is that we're finding loans that are assumable. So we're finding sellers who can sell us their property close to a price that they've always wanted, but we have the ability as the buyer to assume the loan that they locked into place like a year or two ago. And that has been huge for us. We're closing the property Lionsgate here in about a week. It depends on a couple of things of timing, but 7 to 10 days. And we're looking at assuming a 3.6% interest rate.
Yeah, and I think what's really important with that, this deal would not function in today's market if we were having to get a new loan, or the price would have to go significantly down, which we wouldn't get the deal because the seller would not be willing to agree to those terms. But since we know we are going to get those terms, the deal works great. So I think it's just a really powerful tool that is often overlooked. We're so consumed and so assuming that whatever the outside market is saying, that we can't find creative strategies. And this is just one of the prime examples of ways to make deals work and work really, really well.
It's oftentimes it's the only way we can make the deal work. In fact, there are three ways that you could make it work. But this is one of them, is assuming this loan. And at 3.6%, the lowest loan we've gotten before that was 3.5. Like, it's about as low as you can get. Now, there were HUD loans that were lower, but I'm saying from local banks or even Freddie, Fannie. So with this opportunity, we're buying it for $175 a door. Right now, to rebuild it would be well over $200. It's a brand new product. I think it has one vacancy now, but when we got under contract, it had no vacancies. It's smack dab in the middle of Newton, which is a commuter city just 25 minutes outside of Des Moines. And we got creative with it. Not only did we assume the loan, but we actually got to bring on some investors who we've been speaking with for a while. This is their first investment with us, but they're actually able to 1031 into this deal. And I think that's another way that we were somewhat creative on this, is because 1031s typically don't work in our deals because we syndicate our deals. And with syndications, it can become difficult and or not worth the time to jump through all the hoops that a 1031 would cause or provide. But because of the relatively small raise on this, compared to the large amount being sent over through the 1031, we were able to have half of the raise already taken care of just with one investor. So this is a really good opportunity that if you were to, like you just said, Colin, if you were to send this deal to somebody right now and they weren't willing to try to reach out to the bank for assumptions, or they weren't willing to reach out to 1031 people, they may pass on this.
Yeah, so it's very similar to, we're always asking for seller carries on deals, and this is just another tool to make the deal work. Oftentimes, you'll get your underwriting, you'll see the purchase price, and you'll plug in what you know of today's rates. So you'll be like, okay, rates today are, well, now they're 6.5%, 7% maybe. And you look at it and you completely nix a deal. But all of a sudden, you just ask the agent, ask the buyer, or ask the seller, can we assume the loan? He goes back and he finds it out. And sure enough, there's 3.6%, there's 4% sitting right there. Or you ask the seller, hey, what about a seller carry? That reduces the amount of equity you have to bring, thus increasing your return. So I think it's just something that should always be asked, especially in this market.
So I mentioned earlier 3 ways to make it work, right? And I think one of them, of course, is to assume the loan. The second would be to ask for seller financing, like you said, because a lot of times, this is a phrase that is kind of known in some circles, but I've learned this because I learned this day one, and it's worked for me for 9 years now. And the phrase is, I'll either purchase the property at your price and my terms, or my price and your terms. And that's huge. That's huge because typically people will butt heads and say, oh, we're just fighting about this price.
It becomes an ego battle. People have it in their head. They're like, I'm not paying more than $2 million, and I'm not accepting less than $3 million. And it just becomes, nobody's actually looking at the returns of the project. It's just like, well, that doesn't make any sense to go to that price. But if you can lock yourself into maybe a 30-year loan, a 35-year AM that's fixed for those, that's a great interest rate. You have some interest only on the front end. Why wouldn't you do that? You can give on the price right then.
Yeah, so some people will say, I think you guys overpaid for that. And we bought a 20 unit recently where we did pay a tad bit above market, but that doesn't mean the deal doesn't work. In fact, the deal is way better than it would have been for anybody else because we basically had 20% of the entire deal as a seller carry. So now the amount of money needed to close is nominal, and our returns are through the roof because we've barely put anything into the deal. And you structure it so that you're still safe. Don't get me wrong. You're structuring it so that it's interest-only payments. It's at least 5, 7, 10 years down the road. And this allows just a little more debt. There could be a worry that some people have of over-leveraging yourself, but there's a difference here because when you have the seller carry and you only have to pay interest only, and you structure it so that the payoff's far enough down the road, and this is still fitting our value add model, so there's still room to raise the rents. Not that we think this market's going to continue to grow 8% rent growth every single year, but more that it's not even at market today, so we're in a relatively safe position.